This is Dr. Dennis B. Anderson, and this is the third video about the book I wrote, Trading E-mini Stock Index Futures, A New Path to Wealth, the three Anderson models for success in all markets and market corrections. The first two videos provided a general introduction to E-minis and how to trade them. This third video will provide more specific details about this subject, illustrate more chart trading, and answer some general questions. One common question is, how much money do I need to trade E-mini stock index futures? When you set up a trading account with a broker, you need a deposit of about $1,500. I use TD Ameritrade and their Thinkorswim platform, but there are several good brokerages available. A maintenance margin is required in futures accounts, which is at least 25% of the total value of the securities in the account. The margin required to purchase a contract varies according to which index you're trading. Figure at least $5,000 to purchase one contract on average. You also need to allow for possible deterioration in your purchase price. You don't want to have insufficient funds and get a margin call demanding more money within a day or two. So you need at least, I believe, $15,000, preferably $20,000 to provide a secure base where you can begin trading and building the value of your account. It's possible to start with as little as $10,000 and then carefully work your way up to a larger base for trading, but you're subject to some margin calls and you really can't trade more than one contract. What happens with a very limited account of that type is that when you have a really good trading opportunity, say there's a sudden 5% correction in the market, that'd be a chance for you to make some real nice profits. But if you can only trade one contract, you can't buy a second or even a third one to take advantage of that because your funds are limited. After you read, study, and understand my book, you should set up a practice trading account with your broker, where you trade imaginary money as if it were your money. If you're not a seasoned trader, you should practice for at least 2 to 3 months. When you set up your account, you will need to specify the level of your experience. While my book and your practice will prepare you for this, the brokerage needs to be sure at the time you apply that you have the background to not trade naively or foolishly, then lose your money and possibly try to sue them for your losses. After your preparation and practice, it would not be unusual for you to earn $30,000 your first year of trading with your $15,000 to $20,000 trading account. That is only about $600 a week, a net of only 1 or 2 successful trades each week. This is a return of at least 150% on your trading account, which, depending on the size of your total portfolio, can double or triple your total annual return. Let's say you have a trading account of $20,000 and we'll make $30,000 with that the first year. Let's assume your total portfolio is expected to earn 7% a year. If your total assets are $100,000 and you take out $20,000 for your trading account, you will earn $35,600. That would be $80,000 at 7% plus $20,000 at 150%. That is over 35% for the year, not 7%. And if you're just starting out and have $50,000 total, your increase would be $32,100, which would be a return of 64% for the year on your $50,000. This trading account can really magnify your total return on your investments. In the second video, I discussed my first model, Follow the Money, which briefly describes how you trade a trending market. Let's take a look at the second model, Enjoy Those Index Bites. This is a great way to make daily profits trading a flat market. I explain and give examples of this in the book, but this is what you do. Every 6 months, you log the daily range of the index you were trading, going back 30 trading days, about 6 weeks. You rank order, compute the mean and median, and reason out a number between them. Let's say you trade the ES, which is the futures for the S&P 500, and find the average range to be 25 points, including candlestick, wicks, and tails. My research shows that a reasonable profit goal is to trade for 20% of the average daily range, in this case, 5 points. This profit goal is usually about 35% of the single lowest daily range over the past 6 weeks. In other words, you have a good chance of making money with this model. My trading over the years has produced more than an 80% profit rate on all trades. The ES is valued at $50 a point. If you grab just 5 points 6 times each week, you will gross $1,500 a week, or about $75,000 a year, trading only one contract on a part-time basis. Sometimes you get in and see your price run 10 to 20 points, which would be $500 to $1,000 on one trade, providing greater profits. And it's not uncommon for the ES to move 35 to 45 points over one trading day. You're looking for only 5 of those points on each of your trades. Let's move to one of the charts to look at an example of a low trading range. This is the EMD Mid-Cap Index, valued at $100 a point. I'm going to tighten the trading range by limiting to the range between the open and close each day, not the trading of the tails and wicks on the candlesticks. First, notice the stochastic oscillator indicator below, this rectangular chart that you see. This is a momentum indicator with the bottom line value of 20 highlighted there, suggesting oversold, and the top line value of 80, suggesting overbought. As you can see, this indicator was over 80 for quite a few days. In strongly advancing markets, this indicator can appear overbought for some time. That's why it is only used to see confirmation for a trading decision based on other indicators and candlestick formations. You don't trade on this by itself. Look at the steady price increase between September 11 and October 3 of this year. Had you followed my package of indicators and entered a trade buy position there on September 11 or 12, in this area here where the highlight is, you would have earned a profit of about $9,000 in 3 weeks, trading only one contract of the EMD. I'm going to describe this a little bit more on my 4th video, but this is a 9 exponential, this blue line, and the pink line is the 3 exponential, which has a shorter time frame. And you go by the 9 exponential line, and as long as the candlesticks don't close below that, and the 3x stays above the 9, you stay with this trade. So for about 3 weeks, you can just sit and watch as your count grows and your profits increase. Beginning October 3 of this year, 2017 through October 18, a total of 12 trading days plus a weekend and a holiday, the EMD traded in a range of about 1812 to 1822, 10 points, not counting the wicks and tails, which adds to it, of course. The candlesticks for all 12 of these days were basically dojis or spinning tops, both indicators of indecision. The opening and closing prices were very close, and neither buyers nor sellers were trying to be in control. Being at the top of the range is also significant. And the more days of indecision there are, the more likely it is there will be a forceful and significant move away from this compressed range. The market gets like a coiled spring. You can see as it extends a little bit, we still haven't made too many decisions, although the price has inched up a bit. After this upward momentum on October 15th here stalled. I began trading, getting in around 1813, going long, planning for an increase in prices, and getting out around 1818. When price had moved to the upper part of that range, I moved from a 15-minute to a 5-minute time frame to look for confirmation of a move back down, then would short one contract, getting profits from about 1816 down to about 1813. Each of these trades produced profits of about $300 to $500. I used the same 15 to 5-minute shift to look for assurance the cycle was repeating and going back up when it would reach the low range. I made numerous trades over a period of about a week in this area in early October, collecting some very nice profits. Look at the candlestick for October 19. There's one 4 days before that. I'm not sure what happened there. It might have gone down on maybe the Congress wasn't coming out with health care plans the way they expected or something. You don't really know. I wasn't trading that day, but I was on this day on the 19th. It was a up or positive day, but the range of the body was only 4 points. I'm on this one. It closed 4 points higher than it opened. Now notice the tail. I'm sorry, I had this turned around. I got a little ahead of myself. This is the candlestick here, the green one. It opened and closed positive for that day. The sellers came in and drove this down 15 points in the morning, but buyers came in and brought the price back up. That price drop on the tail here was about 15 points. This is the type of opportunity we look for. I wrote in the book about how the importance of monitoring news headlines, including overseas news and government reports, need to be included. Why did the EMD drop 15 points? The main catalyst was a news headline from Spain overnight that Catalonia was becoming more demanding about separating from Spain. There was fear that this could impact other countries and perhaps the European Union. Computers, sometimes referred to as robots, read headlines and control much of the trading. They initiated cell programs which set off other cell programs, producing this drop lower. These types of reactions are often overdone, and the market usually recovers fairly quickly. This was the case over only a few hours on October 19th. I noticed this falling price and put a limit buy order in 3 of my accounts at 1808.5. Buys were triggered as it dropped to that level. And then it started moving back up, and I set sell stops at 1821.9, close to the top of the range that these had been trading in, about 13 points. This resulted in a nice profit of several $1,000s about 4.5 hours later. This was a good return for a few hours of simply monitoring the index. In the book, I write about a 3-day period in 2015 where I traded a more narrow range than this. It was about 8 or 9 points, earning about $30,000 over 3 days of trading. Of course, I traded more than one contract. I have built my contracts and my accounts up to very significant levels and periodically take $20,000 to $50,000 out and move that to ETFs and mutual funds. My primary profession is that of a forensic and clinical psychologist, and I've studied and researched gambling. When I've logged on to trading webinars, they always have a hook to lure the viewer in. They want you to buy a monthly membership. Well, they will tell you what stock to trade, and they usually have some sort of what they call proprietary software they will sell you for several hundred or even more than $2,000. It's always disappointing to watch the written chatter between the attendees where they lament the hundreds or even thousands of dollars they have spent looking for some kind of holy grail for trading. There is no such thing. If there were, wouldn't the people giving the webinar be very wealthy and maybe retired on an island in the Bahamas? They rely on other people to believe in them and send them money for software and memberships. I spent about a year and a half researching, developing, and testing my three models and wrote this book to put it all out there for others to study and profit from. You don't need anyone else to tell you what to do. I have made all the money I need and am now trying to make others aware of this opportunity. I'll again mention the email I have set up to respond to questions about what is in the book and to offer whatever help I can provide to assist in your success. Again, that address is andersonemini@gmail.com. That's ANDERSONEMINI, all lowercase, at gmail.com. Thank you for attention and interest in these videos. You have to be a serious and mature trader with this material, and I wish you all the success you can earn. In the next or the fourth video, I describe my third model, which is very profitable when the stock market has a severe correction. I'll also explain more about the indicators I use and how to trade with them.